Hi everybody, it's Thomas with the second quarter market summary. I thought I'd do a little video greeting since we won't likely be seeing each other in person this quarter. On the screen is my contact info, and you're welcome to share the video if you know anyone that might need my help during this very volatile period. The second quarter of 2020 set a record for the highest return in history. Let's take a look at a chart of the year to date, then we'll look at the firm performance and then details of the market summary. So let's get going. Whoops. Okay. On your screen is 12 months of market performance in a graphic detail. Everything to the left of this dotted line is 2019. Equities were up 28 or 29% in 2019, a big year. We started hedging in the first quarter, and the market had the big decline. If we measure from the bottom to the highs, the decline in the first part of the year was 35%. And now we have had the first top was a 48% rally. So neither of those were very easy to predict, or not impossible to predict. But due to the fact that we hedge portfolios, larger, more aggressive accounts that were hedged outperformed. And if we take a look at our performance, this grid shows us that in the quarter, equities were up, I think, 19 or 20%, but since the firm is 50-50, about half of the firm's money is in stocks and half is in equities. And that reflects the fact that we have very aggressive clients as well as very conservative clients and everything in between. But if you dumped it all together in a single portfolio, it would be about 50-50. So we captured great equity returns and our bond returns were decent. And we measure ourselves against a 50-50 benchmark. If your particular portfolio is 60-40, we use a 60-40 benchmark. Using appropriate benchmarks is something that we focus on so that we're comparing apples to apples. So again, we trailed by a very small margin, 0.6% in a rising market. And the drag always has multiple factors. But when you hedge and you pay for puts or your short calls, that tends to lead to underperformance. There are many, many other variables that allow us to add value. And all in all, we just trailed by a very small amount, which is our mantra. Try to capture the returns in a rising market as best we can while protecting against a big decline. That seemed to happen pretty well in 2Q. Then if you look at the year to date as of the end of the second quarter, our portfolios, the firm in general, is up about 1%. The benchmark for a portfolio like the firm's is down 2%, and we had pretty significant outperformance. And since inception, way back for 17 years, the firm has been making 5% a year. The benchmark to invest like our firm is investing is 4.5, and we're beating. I think I've shown you a slide before that only 20% of mutual funds and money managers outperform over 1, 3, 5, and 15-year periods. So we're in that top 20% at the very least. The other thing I want to always say is that benchmarks don't have any fees of any kind. If we were to dump in what actual returns are for actual investors, the benchmark returns would be much, much lower. Over time, investors are not receiving, the 80% of investors that are trailing their benchmarks or more are trailing by somewhere between 2 and 4%. So our returns, which do include fees, are even much more dramatically better than the average investor out there that really has to pay fees, whether they're advisor fees or mutual fund fees. There's a couple of disclosures for everybody. Returns are after all fees. Since inception, returns are annualized, so that's 5% per year for the last 15 years. Returns are aggregated for the firm. Past performance does not predict future performance. And the other thing is that there's a vast a very large variety of types of accounts. We have aggressive to conservative, people with legacy positions, old clients, new clients, clients that do a lot of self-directed trading. So there is a great variety, but if you dump it all together, that's the average. So let's take a look now at the details of the year-to-date from the market summary. Okay, here's the summary slide that shows for all these different classes from US and foreign companies, real estate and bonds, what happened in the quarter, just in the quarter. So this top line, again, this is a record. It shows down here the best quarter ever is now the second quarter of 2020. Not very many people predicted that during the first quarter that we would have the kind of rally we did, but we did. Foreign stocks that are developed were up huge. Emerging markets had a great quarter, and real estate was great, and bonds were great. All across the board, everything was up. When bonds are up, that means interest rates went down. The average quarter, you can see, is ridiculously small relative to this quarter, and it shows the variety of returns you can get with equities and how bonds are safe. They have relatively low returns, but they have very, very low volatility. The worst quarter is 3% and 2% for the various types of bonds. And in stocks, you've got a 22% quarter versus a minus 22% quarter. I noted here in a note that the first quarter, these are just discrete random time periods from one date to another. And we already looked at the total decline was 35%, but the quarter return from the 1/1 to 3/30 was 21%, just barely missing having the widest range in a short period of time. And if you go across, you see that equities have a very, very high volatility and wide ranges of gains and losses. The more risk you take, the higher returns you get over time. The less risk you take, the lower return over time in general. If we look at a longer term, instead of just focusing on the quarter, we're looking at 1 year, 5 year, and 10 years. So these 5 and 10 year returns are annualized that means per year. And you can see that US stocks over the 1 year period are beating everything. They're beating everything again in the 5 year period and in the 10 year period. The US is in the middle of an extremely bullish period relative to to foreign investments. That reverses and can stay. Foreign stocks have had long periods and emerging markets have long periods of outperforming. People that try to guess and overweight are usually late to the game, get into US and overweight after long periods of overvaluation, usually right as things change the trend. Now we do overweight and underweight a little bit, but not a ton. In general, we try to keep market weights. But this gives us an idea of where we are longer term. And this is news on the bottom versus stock prices on the top. For those of you that I've been talking to, you know that my experience tells me that market prices in the present reflect analysts and investors' anticipation of future news, not present news. Present news is digested and input into current prices, so it reflects all available information. And then what people are looking at or price reflects what investors think is going to happen 9 to 12 months ahead, or maybe even further. So that's why there's so much dislocation between the news right now, which is negative, to say the least, versus where prices are, which is almost at all-time highs. Very difficult to determine what investors are seeing that are justifying this price, but it is the current price. If we look at a longer period of time and the news associated with it, we can see the first quarter big decline and the rally since the big decline. And this is the inset of even a much longer period, which is highlighted. The graph below is just this short period here. And so we can see the big declines, some of the things the Fed did with the stimulus and intervention, which is probably the main reason why stocks are elevated right now. And then you can tell that all asset classes, all types of investments, large, small, and in between, were all up. Foreign emerging markets had the biggest rally. They were the ones that were hit the most. They're the most volatile and they have the highest returns over time. Very hard to stay in them, as you can get endure a lot of pain. I've highlighted the S&P, which is kind of in the upper third. US continues to do great relative to almost all other asset classes. And if we focus in on just US, we'll start to see a pattern that small stocks bounced back, large and value trailed. Everything was up, but risky things went up the most. International, it's the same story. Small stocks went up the most, large and value went up the least, but everything went up a lot. And then in emerging markets, these are the very riskiest, and small in emerging markets are two. Small is risky, emerging markets are risky, very large returns and a big bounce back from the previous quarter. If we look at countries, with developed countries on the left and emerging markets on the right, we can see that there were huge returns in some countries. Usually the country that had the biggest returns probably had the biggest decline in the previous quarter, and they bounced back. I've highlighted the US, which had record-setting returns. And on the emerging market sides, most of these countries got crushed last quarter and are bouncing back huge. I always look at commodities, and we typically have a 2% position in gold when gold gets down to a level that I like to buy it. We got out of gold, and I got out of gold too soon. It's continued to rise even further from the limits where I usually sell gold, and we'll try to get back in if it ever declines. Oil, as everyone knows, had a steep drop during the decline in the first quarter, and I tried to develop a premise and get a 2 position in oil, but I couldn't do the due diligence in time, so we weren't able to capture any of the rally in gold. But I'm always looking at small positions in commodities when they reach levels that have support. So this is the final, usually editorial from DFA, and it's always the same message, which is try to not let the noise bother you, try not to predict the direction of the market, and try to find out the allocation that will achieve your goals and that will allow you to endure declines and maintain your allocation. If you're 60% allocated in a bull market, you need to be committed and be able to endure a decline and endure the losses so that you can buy shares and maintain your allocation at low prices. So that's what we do with a kind of a hedge on top of things when needed. And that's it. I hope you find the material helpful. And if you have any questions, you're welcome to contact me anytime. Thanks a lot. Bye-bye.